Hello everyone, hope you're doing well. I'd like to give an update on maximizations.com and also on IceT, the investment checklist tool that I've been working on. It's been a couple of months since I last gave an update. So I did a little bit of changes, reorganized some of the checklists on the complete guide of stock picking to achieve a good returns with your investment portfolio. So I'm going to go through some of that with you today. So as of today, I've been investing for about 10 years now, since 2013, I think. Only in the past 5 years, I've been tracking my investment returns more seriously. So far my returns since the inception of early 2020s until now, it's at a return of about 155%, and my CAGR is at 21.4%. It's pretty close to the rate of returns that I'm aiming for, which is 21.5%. And at this point, I'm quite confident that going forward, the CAGR is going to be higher than 21.5%. I may look to increase my target to 23 or 24%. Let's see. So the important thing is during the past few years, for all of the investments, or maybe I can say trades as well, for the investments that I didn't make a profit on, and if I didn't hold them for more than 1 year period of time, I would analyze the decision quite thoroughly and very carefully as well, to identify why it was actually a mistake, and to ensure that the chances of me repeating this kind of mistakes in the future is very minimum. So I think mistakes, it's expected in this journey. In an investment career, you are expected to make a lot of mistakes, but the very important thing is we should learn how to profit from those mistakes in form of lessons, and implementing processes and systems, so that we don't repeat these kind of mistakes in the future. So going forward, I'm quite optimistic that the performance that I can obtain is going to be rather satisfactory, and in the long run I can continue to outperform the market. So as just cover quickly on what are some of my main portfolio holdings as of today. So Fortinet, Spotify, Netflix, and SPS Commerce, they take up the majority of my portfolio at the moment. One of my highest conviction stock, it's still AXON, which I wrote about and speak of extensively in the past. It's one of the companies with the great growth prospects, excellent fundamentals, with good management holdings, good management quality as well. But unfortunately, the stock's valuation has gone up quite a lot, especially from a PS ratio perspective. So I will look to buy into the company in the future again, when the valuation gets into a more fair range. So over here, moving on to the complete guide to create a winning stocks portfolio to achieve your financial goals. So I have reorganized all of the checklists that I've included inside here in a way that is a lot easier for the users to go through and apply to their own investment journey as well. So let me just go through the structure. So as a start, I'm going to be highlighting on the importance that readers or people who want to get started on this journey, to make sure that they develop a good financial foundation and habits. So they're going to make sure that they pay off all the high interest debts. For example, credit card. Let's say if the credit card debts interest, they can range from 15 to 20%. It just doesn't make sense for you to start on your investment journey when you're being charged such a high interest rate, because it is very, very unlikely that you would be able to generate returns of up to 20% per year. So it makes sense to eliminate all of these high interest debts first. And you also want to build an emergency fund that will last you from 3 to 6 months. So each of these blue link over here, they are actually hyperlinks, which will be linked to a microblog that I've written on separately. And inside here, you can see like some of the tools that I've inserted. Either it is Google Sheet templates or other spreadsheets that you can download and use for yourself. Just fill in the numbers respectively where it meets your needs. And some of them will be inclusive of the free online tools that you can use while you are going through some of these blocks over here. So, of course, one of the main reasons why it's very important to first have an emergency fund before you start embarking on an investment journey is you want to make sure that whenever market correction happens, which can span for a period of up to 1.5 and 2 years period of time, you wouldn't need to liquidate your investments, and you have emergency funds set aside for these rainy days. And also I have a budgeting template that you can download and use on your Google Sheet as well to track your daily expenses and ultimately help you to save and invest more, build up your emergency fund quicker, and also to increase the amount that you can use to invest on a monthly basis. So again, one of the main I think one of the main benefits of this complete guide that I've provided for users is first thing I emphasize on encouraging the users to identify what are their financial goals, how much money do they want to save up for. So what's the purpose of it? Is it for early retirement, funding certain large purchases, for example, a down payment for a home, financing their children's higher education costs, buying a car, etc. So you should work with an end with mind, know what is the financial figure that you are aiming for, and then work backwards, calculate the amount that you are able to set aside every month to contribute to this fund. And with that, you can work out what are the targeted returns that you should aim for every year, so you can maintain you can achieve your financial goal. So this is one of the new blogs that I've written. If the targeted returns that you calculated, it's less than 10%, so I would highly encourage that you proceed with investing through S&P 500, doing the passive investing method. So investing in ETFs like SPY. So on this blog, I actually detailed it quite clearly. Why the chances of you achieving your investment goals if your targeted returns is only 10%, it's going to be very high if you just embark through passive investing method. And you don't have to worry about diversification, and it requires almost no time at all to monitor and perform deeper analysis as compared to individual stock picking or the route of active investing. So contrary to popular beliefs, active investing, picking individual stocks actually require a lot of effort, a lot of time as well. The effort and time can be streamlined and can be improved when you have a system, a set of checklists that you can refer to. For example, this checklist that I've created over here, and some of the system and tools that I'll be showing through some of these micro blogs also. However, it is something that you need to monitor at least once every quarter to make sure that all of the important aspects such as the valuation, the fundamentals, and the growth prospects of your individual companies, they are still intact, they are still aligned with your targeted returns to help you achieve your goals. So if active investing is something that is I would only recommend to people who are, if they yearn for higher than 10% returns per year, and also if they are very interested in this field, interested in doing active stock investing, interested in analyzing the companies, etc., then this is for you. So over here, I broke it down into a few sections. Here are some of the key concepts that you need to understand first. So you need to understand that it's very important to stay invested. Doesn't matter if you are doing active investing or passive investing. Try not to interrupt the compounding effect of your investments. Try to stay invested. Don't try and go in and out of the market. So I highly recommend reading this. It is one of the more popular blogs on my platform. And also the importance of analyzing the company's past financial performances. Although past financial or performances, they are not an indicative of the future performance, but it gives you an idea of the current status, the current health of the companies that you're investing in. The systems, are they in place to increase the chances of them surviving and thriving going forward into the future. And so I implemented I arranged all of these checklists in a way that will be more efficient and also effective for the readers and myself to collate a list of companies that will be high quality and lower chances of these companies going wrong, which will result in permanent loss for the investors. So this method is what I call the elimination method. So I believe that some of our most important resources in life, and arguably they are non-replenishable as well, is our time and energy. So I want to make sure that the way that we analyze these companies in a way that allows us to reduce the chances of us being wrong significantly, while increasing the chances of us being right. So the way I include and arrange all of these checklists over here is to allow the users to filter out companies which should be eliminated, and it doesn't warrant further investigation because they have failed a certain checklist. If let's say you come across a certain companies and upon checking their price to sale ratio, their valuation, you find out that they are overvalued. So it wouldn't make a lot of sense for you to continue to do a deep dive on this company to see if the fundamentals are great or not. I mean, you can still do that, but it'll be wiser to put it on your watch list first and come back and revisit again when the price to sale ratio or the other valuation ranges have fall into a more fair value. Because by the time when that happens, the fundamentals, growth prospects of the company may change by then. So similarly, it goes to the other areas like growth and fundamentals as well. So it's very helpful to look at companies which, their growth potential is very in line with your targeted rate of returns. Let's say for someone like myself, where my targeted rate of returns per year is 15 to 21.5% or maybe more in the future, it would make a lot of sense for me to invest in companies where their future top line growth is estimated to be at least higher than 15%. So if that's the case, when the companies, the stock prices increase at a rate of 15%, from a PS ratio valuation, the chances of them being overvalued is going to be lower. Then moving on, we want to look at the fundamentals. So of course, if you are buying a company, you want to make sure that the products and services that they are selling are of decent, at least decent, and preferably good quality. So here are some of the ratings that you should look at, depending on what kind of services that they are selling. If they're selling software, you want to look at G2 for the software reviews by the customers, not just from the reviewers, because that could be biased. If it's a company which is focusing on distributing their products through a form of a mobile app like Duolingo, Airbnb, Mercado Libre, the e-commerce platform, for example, you want to make sure that the mobile app ratings, it's good. Spotify being a key example as well. If it's a restaurant, F&B business, or if it's an apparel business like Lululemon, then you want to make sure that the Google reviews of their stores and their restaurants are of decent ratings also. So that's a given. If you're going to buy into a company, you want to make sure that the customers actually give good feedbacks on their products and services, because in a lot of the industries that you look into, word of mouth is one of the most powerful marketing method out there. So you want to make sure that people are actually looking for the company. The Google search trend should be healthy, and the web traffic should be good as well. So down at the bottom of the link, I included a microblog to show how to evaluate and analyze a company's marketing funnel to see how effective are their marketing efforts. And next, you want to move on to financials. So again, using the elimination method, first of all, we want to check out the company's balance sheet status. I want to make sure that the company is not in a very high debt position, because if the company goes bankrupt, as ordinary shareholders, we are the one that will be affected the most compared to other holders like bond holders, for example. So we want to make sure that chances of the company going bankrupt is very, very low. And here are some of the ratios that are included. So for some of these ratios here, for example, I have included like the tools, where to find them. So I include like real life examples. A lot of it is the companies that I am holding as well. And what are some of the platforms, the free platforms that you can use online to find these ratios. And I also include what are some of the benchmarks that you should be paying attention to. For example, if it exceeds 50% for net debt to equity ratio, and if their interest coverage ratio is less than 5 times, for example, these are some of the red flags that you should pay attention to. So moving on, of course, you want to invest in companies that have positive cash flows in terms of operating and free cash flows, because although profit is very, very important, but in the as an analogy, in the from an accounting perspective, cash flow is actually oxygen for a company. So companies that they in negative cash flows, especially for extended period of time, it can be a very dangerous sign for the survivability of the company. Then moving on, we have the revenue trends, and also, as I mentioned earlier, revenue trends, it's very important, and if it's exceeding the industry growth rate, then it's a sign that the company that you're analyzing, they're actually taking up more market share compared to the other players in the market. Then we look at profitability ratios. Here are some of the examples that I've listed. So again, all of them I've included tools and real life examples, and it's quite visual as well. So it's very easy for you to follow, and clicking on all of this, it will so this is an example. It will bring you to the platform itself, where you can actually look at the real-time numbers on the respective platforms. And of course, you would prefer to have companies which are growing globally once they have gotten a decent market share in the domestic market. So it's a very good sign when they're expanding internationally to other countries as well. And moving on to the next part, under fundamentals, of course, you want to look at the management and the culture of the company. So as you can see at this point, the way I've arranged all of these checklists, it allows you to analyze the company in a way that is quicker, hence the elimination method. So the financials over here, a lot of these are actually ratios and benchmark based. So you can access a lot of all these numbers on this financial aggregators platform. Let's say if you find out that the revenue growth is not growing as fast. The company is in a very bad balance sheet position. You can come into a rather quick conclusion that the company is conclusion or assumption that the company is not doing very well as the numbers they show. Then only then we move on to evaluation of criteria, which is a little bit more subjective. Say for example, the quality of the management. So these are not information that is quantified exactly. It is not exactly easy to find. It requires a lot more soft evaluation of all these kind of things. So and in investment, we for especially for stocks and equities, we want to make sure that we gather all of the information, the knowable information that we have, and we try to make it quantifiable as well. It's impossible to quantify everything, but the ability to collate a list of key quantifiable ratios in a way that is dependable, and then to connect all of these dots together. We try to reduce the chance of us being wrong in investment, and then subsequently try to improve the chances of us being right. So a lot of part of successful investment from my experience is you want to make sure that we are in a high probability of succeeding. So it's actually so quoting Edgar himself from Greenhaven Associates, mentioned that investment is actually a probabilistic game. So we want to make sure that whatever decisions that we make, we want to make sure that probability of us going wrong, making wrong decisions are low. So continuing from management and culture. So it's good if we invest in companies where the founders or the C-level staffs, they own a high amount of the companies. So over here, I include like some of the tools that you can see where to find all of these key figures. So over here is Fortinet, for example. Getting these figures from Simply Wall Street, you can see that Ken Sear and Michael Sear, which are the founders, CTO and CEO respectively, they own up to 15.7% of the company, which is a pretty high figure, and that's a very good thing to see. So another example is we want to see if the company's the CEO compensation is mostly compensated in stocks rather than in salary. So they operate with a ownership mindset instead of like a salaryman mentality. So over here, I include some of the tools that you can use as well on where to find these figures. So here are the example of Fortinet. You can see the compensation, most of it is actually on equity base, and they only receive about 1.2 million in cash compensation every year. So it's a very good sign when you see CEO being compensated this way, because we have a shared interest. They want to make sure that the stock's performance is going to be doing well in the long run as well, because that's going to be increasing their compensation directly. And I also include some of the other companies for references. Then I move on to something which is a lot more subjective, and you can't really quantify it so much. For example, it's very important that we invest in companies that have an innovative culture. Particularly important when you are investing in companies in the tech and IT sector. And it's also going to be enormously helpful for non-tech sectors like apparels in these days as well. So we'll look at if the company's employees mix, how many percentage of it's in different department. Is it aligned with the company's growth strategy or not? So I include some examples over here, how you can build up a chart like this. So this is an example from Fortinet. So as you can see, these are the data that I obtained from their LinkedIn page. I can see that 43% of their total team members are from the IT and engineering department, and 34% are from the sales and business development. So to me, it is a very good sign because it shows that the company is very engineering focused. And in the meantime, the high amount of sales and business development team members indicate that they place a lot of importance on continuing to grow their market share as well. Then we want to move on to competitive analysis. We want to make sure that the company they have some form of economic moats, like switching costs, network effects, efficient scale, etc. So these are information that requires you to have a better understanding, and it will help if you have a deeper understanding of the company's business model, their products. So within each of here, I included some of the tools and methods on how you can identify in a quicker way if these companies they have moats or not. You can use AI tools for them using the right prompts. They may not be the right answer immediately, but at least they provide some good starting point for you to start your more in-depth research for some of these companies that you're looking to analyze. And you want to make sure that the company have high customer lifetime value. So moving on, I have the other two segments over here, which is some of the risks and threats that you want to watch out for these companies, and also some of the bonuses and favorable traits that the companies may have as well. So you want to make sure that the company that you invest in, they do not have too high of an antitrust threats. So here I have an example. So companies like Microsoft, Meta, Alphabet, Amazon, Apple, these are great companies, great fundamentals, and a lot of them, from valuation perspective, it is still fairly valued, and they have some of them they have continue to have very high growth prospects going into the future. Namely, like Microsoft, they are very dominant in the cloud space, data center space as well, which are both segments and industries which are growing very, very quickly. However, having said that, these companies, they do face antitrust threats. So there could be chance that the company may be forced to sell off some of their segments, and this could result in a lot of volatility or possibly permanent loss for the company's valuation. Therefore, as investors, we want to make sure that the antitrust threats which are present in some of these companies that we hold in our portfolio, they should be kept at a minimum level. And over here, I list down some of the ways to identify if the companies that you're holding, are they subjected to these antitrust threats or not. Then of course the last segment, we have the bonuses and favorable traits to look for. So it'd be good if the company is founder-led. Over here I list down some of the examples in the past. So the data over here shows it's a rather small sample, but it'll give you a good idea. Like these companies over here, during the founders period of time, their returns significantly outperform the post-founder period once they've been succeeded by another CEO. And here are some of the examples which also counter it counters the point earlier. It's not necessarily a downside if the company is not exactly founded. If the quality of the CEO is good, the company can still be led in a very good way. So after doing all of the analysis, there's a section over here that I share with the users how to allocate the weightage for the stocks. So before moving on to this section and the rest of the ones over here, so as you can see, there are quite a lot of checklists that I've included over here. I would say that this is a very comprehensive guide. There are a few more checklists which I use on a personal level, and on my own personal notes I haven't included inside here yet. I plan to include them progressively in the future. So if you follow through a lot of the checklists over here, you have a checklist system like that. I'm quite confident to say that I'm quite confident that you will be able to have a very organized structure that will help you to obtain more desirable outcome and results if you are to embark in an active stock picking method. So one thing I realized in achieving good investment returns is knowing where to find knowing the right questions to ask is very important. So these are like this can be considered as some of the right questions to ask. What are the signs of a good and healthy company that can be a good investment opportunity? And the next thing, very important thing as well, is to know where to find the answers on the right questions. So inside all of these blocks here, I've included the tools, some of the examples on where you can find the certain ratios, where you can find the signs that indicate if the companies are meeting the checklist or not. And the last important trait of successful investment is the ability to connect all of the dots of all this kind of information that you obtain in a way that will help you to make a good decision when it comes to investing. So knowing the right questions to ask, knowing where to find the answers for all of these questions, and the ability to connect the dots. So connecting the dots, it is in a way to organize all of this information in a way that is going to be easy for you to review and organize. So that's why I built the IceT tool. So IceT stands for Investment Checklist Tool. It is an overview dashboard that it allows users to create their own checklist and rate the checklist accordingly, and also include their due diligence findings for the respective assets on a checklist level. And there will be a score at the end over here for each of these status, depending on what you choose. Be it if it's a pass, then it's going to add a score to it. If it's a fail, it's going to minus a score, and any other statuses over here, it's going to be set on neutral for the asset score level. So over here, this is the investment board that I use. These are the companies that I'm holding. So you can see like all of these checklists are the checklists that I have listed based on the sequence of the complete guide over here. So using Spotify as an example, so PS ratio for Spotify as of today, there's a note section over here that you can include your notes. You can see that Spotify's PS ratio as of today, it is at 5 times. So on my own benchmark, if PS ratio is below 10, I would guide it. I would rate it as a pass status. And you can see the industry growth for Spotify. I set it as mediocre because per Statista, it is showing that there's a 4.9% expected CAGR until 2029. For the product rating of Spotify, I set it as a pass because if you're looking at the App Store ratings, they've got pretty good ratings, and they are ranked as number 1 in their respective categories. Then I have the financials over here, the financial checklist which I mentioned on the complete guide. Their free cash flow amount is on a rather healthy trend, but it's not exactly great. You can see it's not exactly on a steady, consistent increasing pattern over here. Some of it is like falling. In 2022, it almost went to a 0 or negative figure. Therefore, I would just rate this as a mediocre score for now. International sales growth. So Spotify, although it's originally founded in Sweden, but per the data over here, you can see that they're actually growing internationally outside to other countries as well. So it's a very good sign. So I've rated that as a pass. And Spotify is owned very high by their insiders also, for the data that you can see here. So Daniel Ek is the founder and the CEO. He currently owns about 6.6% of the company, and his co-founder and director owns 11% of the company. So this is a very good sign. That's up to about 17-18% ownership of the company, which is considered very high. Therefore, I would rate this as a pass. And also because Spotify is listed as 10 years, listed less than 10 years only, so it could be a good opportunity for a lot of potential room for growth for the stock price perspective in this sense. So this is a checklist tool that I encourage you to use. I mean, if you're just going to be reading through all of this, there should be some way that you can organize a lot of your findings, and then you should be able to rate it as well for each of these checklists. What status are they? Are they a pass? Are they considered a fail? And there should be a score over here that can help you to quantify it from a fundamentals perspective, how the company is actually doing, and you can compare it with the other assets. So this is a work in progress. We will continue to refine, add more useful features to this platform, and I also encourage you to add other checklists inside, which you see will be helpful also. For example, like SWOT analysis. So all of these checklists, they are not fixed. You can amend it by yourself. So you can go ahead and insert your own notes over here. So for example, put in today's date, and say based on my studies, and you can insert insert own notes over here, and you can review it in the future as well. So after going through the checklist and ranking it for your companies, there comes the next stage to allocate the weightage for your companies. So let's say if you build up your watch list with a tool like IceT, and let's say you identify these are the list of companies which are you would like to add to your portfolio. So you would want to next thing you want to identify what are some of the weightage that you want to allocate for each of the stocks. So this is a tool that I've built. I think this is one of the most helpful tool that I've built in the last year. I call it the grid portfolio allocation grid system. So I included a template that you can download through this blog also. So what you want to do is for each of the companies, you want to rank them insert them on the grid over here based on their growth. How much growth are they expected to provide in the next few years? What is their current valuation? Growth meaning like revenue, expected revenue growth. You can obtain these figures from the guidance figures, which is provided by the companies themselves. It will be very useful, especially if the track record in the past has been shown to be quite reliable. Otherwise, you can come up with your own revenue growth projection using the industry growth rate. And also, if you like, as a reference, you can use the analyst forecast figures as well. But I would encourage you to come up with your own findings and your own consensus instead of relying on analysts' forecasts. Then you want to look at the valuation. So inside here, I list them into 3 brackets. Either they are low valuation, which is less than 10, or 15 this is the old figures, 16 to, let me just show you the updated one over here. Yeah, so either less than 10, 10 to 16, or if it's more than 16 PS ratio, then you'll be considered as overvalued. And also, what are some of the fundamental scores in 3 tiers? Either less than 50%, 50 to 70, which is considered as mediocre, and more than 70%. So the fundamental scores, you can obtain it from the asset score over here. And over here, these are the current allocation of the portfolio, or of the stocks that I've included in my portfolio at the moment. So you can see there's an attractiveness ranking. For each of these tiers, each of these combination over here, you should rank them, which combination is the most attractive and which one is the one that the ones that you should try and avoid. So this is very helpful because it gives you like a visual on what are some of the allocation that you have assigned to these companies in the respective tiers. And you would want to try to reduce the allocation for companies which are in the lower attractiveness ranking. So currently AXON, ServiceNow, and Duolingo, HubSpot as well, these are companies which are still, they still have very great fundamentals. They have a lot of promising growth prospects going forward in the future as well, but because their valuation is at a very high range at the moment, so I would rank them at a lower attractiveness ranking, and therefore reducing my allocated weightage for them. And from time to time, you would want to rebalance your portfolio. So for example, if you have allocated 10% for Spotify in your portfolio, the company's stock may increase, may run up by a lot, and it may go up to 12.5% or 15%. So with reference to the grid, the portfolio grid of your own company, you may want to perform some rebalancing, meaning to say you may want to sell your Spotify, and sell some of your Spotify and rebalance it to another portfolio. So over here I have a rebalancing decision chart that you can use as a reference. And in what instances you should not proceed to rebalance the stock. For example, if the valuation is still okay and there are no other companies which fundamentals or growth prospects is better than the company itself, then you should continue to let the winners run. And over here at the bottom, I included some other additional readings that may be interesting for you. At the top section over here, I included some case studies of real investment examples. So AXON stock report, this one is the most comprehensive one. It covers through most of these checklists that I've mentioned, so you can see it on a deeper level for a single stock. How does it look like when all of this information are being presented? So personally, I would still organize all of these findings on IceT instead, because I think I found it to be a lot more efficient, and for me to update all of this information, it's a very efficient way for me to review it from time to time, especially every 3 months minimally. When a new quarterly report come out, I'm going to have to update a lot of the figures, the financial figures. So I found that IceT as a platform is a way better tool for me to do that. But this blog over here is just a representation for you on a document format that will show you an example of a company that is conducted in an in-depth research format. And some of the so one of the benefits of IceT as well is the filter function. So as of right now, you can see that the PS ratio for S&P 500 is at 3.11. So from historical perspective, that is considered the highest. So for investors who are planning to do periodic in investing for the next few months, maybe they have bonuses, they want to invest a larger sum amount of money into the market, but they are concerned about the high valuation. So with a tool like IceT, once all of these figures are being updated, they can use it to filter, to identify assets which are more suitable for them to perform periodic investing on for this period of high valuation, while reducing the chances of volatility or permanent loss in their portfolio. So what they can do is they can go to the PS ratio over here and then filter for companies which the PS ratio is on a pass status only. And if they like to, then they can go to the revenue growth and filter for companies which the revenue growth is going to be expected to be continue to be high. So that will filter up all these kind of companies for these kind of potential candidates which are more suitable for their investment plans during a period of time. Another example is, for example, if I want to identify companies that I can hold for a long period of time. Let's say I expect to continue investing for the next 20 or 30 years. I want to identify what are some of the companies that I can hold for the next 10 years, for example. What you can do is you can filter for companies which are founder-led, and preferably companies which are hold for there's high insiders ownership by those C-level or founder-led companies, executives. And also maybe you want to see some of the companies which are listed less than 10 years that could present itself as a more opportunities for you, and they'll filter out these kind of companies over here. And you could use the PS ratio to filter out the companies which are overvalued as well, and that leave us with Spotify in this data set of example over here. So yeah, that's the usefulness of IceT. I highly encourage you to check it out, play around with it. It's going to be a very useful tool, your companion, and a platform for you to organize a lot of your findings, and it will serve you pretty well for the long run. Yeah. So okay, so that concludes pretty much on all of the updates that I like to provide for this round. All of the complete guide that are updated. So yeah, do check it out, have a read at it. If you're interested to find out more, you want to discuss more ideas, and you have some questions that you want to ask me, feel free to leave a comment. And if you find that this guide has been helpful for you, do bookmark it and share it with your friends and families that you think they're going to be able to obtain some value out of it. So yeah, thanks so much for listening to this point. I'm very happy to be able to share this journey with you guys, which I enjoy so much, and I look forward to continue to continue to do for the foreseeable future, which I'm very excited and optimistic about. So yeah, thank you so much. I wish that you have a successful investment journey ahead. Thanks.